Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Phil. It's always great to have you on the podcast show.
Okay. Hey, Bilal. Happy New Year.
And to you as well. I guess, we're going to do a run around the entire world on your economic and macro views. But before we do that, obviously one thing that, seems to color everything is Trump. We obviously have his second term, his inauguration is coming up. So we're actually going to see him, in action very soon. A big question we all have is we had Trump 1.0. And so we had that as one sample. Now there's Trump 2.0. And so from everything you've seen or the noises you've had from the incoming administration, how are you interpreting and predicting Trump policies in Trump 2.0?
Yes, I think, you're dead right. This is sort of a big unknown, big uncertainty. And, I don't want to be too definitive. So since the election or even before that, I've sort of sketched out what I think of as a sort of plausible distribution of policies and therefore outcomes. And I've kind of put them into three buckets. I call one, the Trump mild, one, the Trump aggressive. Those are the two tails. And then the one in the middle, which I would put something like a 50% weight on, maybe 20 on the aggressive and 30 on the mild. The one in the middle is what I'm calling Trump at face value. And I actually think, he's the sort of, love him or hate him, he's the sort of politician that says what he thinks and tends to do what he says. So the Trump at face value scenario, in some sense, I think is the modal one and the one that we should probably be kind of gearing our views upon.
And so at that face value one, so there's a number of policies that economists or investors are focused on. One is tariffs, which, a lot of people are focusing on for the inauguration sort of period, executive orders, immediate ones. So maybe we can start with tariffs and then we can go to some of the other ones after that.
Yeah, I mean, I think, the most important aspect of Trump at face value is he's what we economists would love to call, he's an autarkic politician. He believes in protectionism, in isolationism, in America first. That's his selling point. So I think you need to recognize that some form of dramatically stepped up protectionism is very likely. Now, because there's an extra angle to this, which is he's been pitching that this is actually a public finance narrative as well. In other words, we can rotate the nature of our tax system towards excise duties or customs away from income taxes. That's completely implausible. We can talk about the fiscal aspects of his program in a moment.
Just on that implausibility, I mean, him and many people in his movement make reference to the 1800s, like let's go back to those days before income tax. The US grew rapidly on tariffs and so on.
Yes.
So you're a very experienced economist. I mean, what would you say to that historical reference point?
Well, it's an interesting, it's actually, it shows a complete ignorance, to be honest, but it's an interesting point to make. But because at that point, federal expenditures were, several, 3-4 percentage points of GDP. So yes, you could run the federal, maybe not even that much, to be honest. You could run the federal government on indirect taxes collected at the border without running a deficit, too much of a deficit at least, apart from during war times. So of course, during war times in the 19th century, the US did default, but we won't say too much about that issue. But seriously, the issue here is that, we now have a federal government that everyone likes to spend money in the order of 20% of GDP. So you can't fund that with indirect taxation. You could fund it, actually, interestingly, you could probably fund it if you put in a very aggressive VAT system, similar to Europe. That would help raise a decent chunk of revenue, but you certainly couldn't fund it through very steep border taxes. Not the least of which, and this is quite an important point, you could argue pretty obvious, but quite an important point is that, there's this darned old thing called the Laffer curve, which means that, when you put tax rates at zero, you collect zero. When you put tax rates very high, you also collect zero. Somewhere in the middle, there's a sweet spot. And on tariffs, that sweet spot is probably below where we are now. We're already seeing tax revenue from tariffs from its first set of hikes decline. And I think that just reflects the fact that people respond to tariff hikes. They change their behavior. Trading partners change their patterns of shipping goods and the like. So if you put tariffs on China of 60%, probably wouldn't collect much revenue because the Chinese would find alternative means of getting goods into this country through other channels. So that's a very important constraint on the use of this tool. But I think the most important point is coming back to the bigger picture. He will raise taxes on imports, and that will raise U.S. goods prices. It's not a very complicated message. Then the discussion is what effect does that have on the broader inflation picture?
Okay, and one difference it seems compared to Trump 1.0 was that in Trump 1.0 you had what I guess one could call like narrow tariffs, certain sectors, certain countries. This time he's talked about universal tariffs, like 20% on every country in the world. So it would be, do you think that's plausible or not, or is that?
Well, yeah, as I say, Trump at face value, take him, he's going to try and do it. I mean, there's an issue how sustainable it is. He might be talked out of it, but I doubt it. Then it might not all happen at once. There's all these variants. We're not sure if any tariffs will be levied on Mexico and Canada, but after some of the initial comments, you'd say yes, they will be. So, it's a very much a moving target here, I would say. But my point would be that the increase in tariffs is likely to be substantial and far more substantial than it was in the first term. Because going back to the first term is an important point to make, that was really a tale of two halves. There was a sort of conventional Republican president in the first 2 years who did the same stuff that George Bush had done, or Ronald Reagan, or predecessors. And then there was the populist Trump in the second 2 years. And the second 2 years were a disaster. The first 2 years were kind of okay. They blew the deficit steadily apart, but they didn't cause much of many other problems. Inflation went up and the Fed tightened. Second 2 years were a big problem. And that's the narrative that I like to extrapolate into the next 4 years.
And just remind us what happened in those second 2 years.
Well, primarily, we were actually in a fairly weak global goods pricing environment. That's an important contrast to where we are now. We've had goods price inflation. Goods producers, I think, are much more used to raising prices than cutting them. So we'd had almost 20 years of goods price deflation by the time he imposed these tariffs, but they still went on to final prices. And we did see some acceleration in core goods pricing, and that was one of the reasons the Fed was tightening in 2018, 19, into early 19. But the big effect that the tariffs had, which I think is possibly slightly different this time, is that they had a much more negative effect on global activity, including on the US. So, we had a lot of weakness developing in global goods markets quite quickly, and growing fears of a manufacturing-led downturn in the global economy. And that's one reason why, we kind of forget it just on the edge of the COVID outbreak. That's why he sued for peace against China in December 1999, or maybe it was January 2020. There's a pretty humiliating press conference that he held in the White House where he announced this new program, this new agreement that he had with China, and how wonderful a fair trading partner China had now become. I kind of think at some point someone's going to bring that tape out and kind of remind him that, the world isn't quite as he's been characterizing it.
I mean, you said there that back then it had a negative impact on global activity, and you said it may be different this time.
Well, I think this time it will be equally negative. So in a sense, the outlook that I see developing, conditional on Trump tariffs being imposed, is for an edging up in the US inflation rate from where we are, particularly led by goods inflation, a weakening in US growth as we go through the year, but a much sharper weakening in global growth once the tariffs are clarified and implemented. So in a sense, the shock to global growth is somewhat asymmetric. It's somewhat not evenly distributed. It's more of a burden on the non-US economies than it is on the US, at least initially.
Okay, understood. Now, another part of the Trump policy that could impact growth is his stance on immigration or
Yes.
illegal
Yes.
immigrants and so on, kicking millions, 20 million. I can't remember what the last number he had over the campaign. How do you see that?
Well, in a funny sense, while I love to talk about tariffs and talk people through how the price effects feed through and all the assumptions you have to make. Reality is it's a significant set of effects, but in order of magnitude, especially on the growth side and possibly even on the inflation side, it isn't probably as important as some of the looming changes in labor supply. And I say looming is probably that's they're actually already happening. One of the features of US growth for the last couple of years, or particularly 2023, was that we had this big surge in the labor supply. And that gave us an ability to grow more rapidly, to add many more jobs than might have been expected, especially given the development in the unemployment rate. So we found to have a very nice outcome where we had a rising unemployment rate, diminishing price pressures through that channel, but also strong employment growth and solid growth. And the big driver of that was an increased labor supply. The big driver of that was migration. Now that has already tailed off. Whether you credit Biden with this or say it was just a reflection of the supply side on the migrant front. In other words, people were rushing into the US after COVID, and then that rush faded, which I think is actually what's been happening. But as we go into the Trump era, he's going to take aggressive action to turn that tap off and begin to reverse it. Now, I'd be skeptical that he'll be going around, rounding up 10, 15 million illegal immigrants. That's not, who knows? That's part of the Trump aggressive scenario. But I think what's going to happen is that we will see a massive tailing off in net immigration to the US. It's already happened, but it will continue. Probably enough to put US labor supply growth close to zero in 25 and 26. So if you think of it from a supply side perspective, that's a big negative for growth relative to, say, 22, 23, and early 24.
Okay. I
And
mean,
and by the way, because it's supply side, a leftward shift, as it were, in the supply curve for the economy, it's probably going to raise wage pressures, especially at the lower end of the spectrum.
yeah. I mean, I guess one offset there is this rise in productivity. So we lose on the labor supply, but we gain on productivity. I mean, there's a big narrative on the productivity side that people
Yes.
have. I mean, the Fed wrote a paper about it recently and such. And what do you think on that?
Well, I mean, there are facts here, and the facts are that US productivity growth has been impressive. In other words, it's accelerated slightly relative to the pre-pandemic trend, but it's still below where it was, in the 90s and in previous periods. The stunning development, of course, is that everywhere else, productivity has fallen, not just growth fallen, but it's fallen. So it's the relative US performance that is so stunning, not on a time series basis, to be honest, but on a cross-sectional basis. So in some sense, the productivity riddle is more about what's been going on abroad than it is what's been going on in the US. I'm not a massive optimist on sort of the AI boom. I think there's a lot of hype there, to say the least. It reminds me quite a lot of sort of late 90s, early 2000s sort of tech optimism. Um, my takeaway actually from the tech boom of the last 20 years is it's actually been quite disappointing in terms of its growth payoff. It hasn't been disappointing in terms of its payoff to the owners of that technology
Mm.
and their ability to generate returns. But for the broader economy, I'm a bit skeptical
Mm.
of the
And how
result.
about deregulation and that side, whether that would unleash the supply side, boost productivity, and so on?
Well, the problem with deregulation is most of it is, again, a transfer from one sector to another. You know, certain sectors that were being suppressed in the last 4 years are going to gain. And certain sectors that were gainers probably lose a bit. I'm very skeptical that, I mean, this deregulation thing is a massive myth, in my view. It's
Okay.
all about, I mean, take Linda Carr as
Yeah.
the, or
Yeah.
the FTC, after, yeah, FTC. Her job was to try and get on top of monopolists.
Yeah.
Now, the theory I grew up with was that the fewer monopolies you have, the more efficient economy you have,
Yeah.
broadly put. So, in principle, that policy was probably good for economic efficiency. But of course, anyone whose merger was quashed or whose monopoly powers were investigated called this outrageous regulation. And this needs to be, needs to be unwound. And so I think it's all about, frankly, the growing rise, to be honest here, the growing rise of crony capitalism in the United States. This is a problem. I mean, it's a problem that we'll come back to talk to in decades' time when we look back at this era.
Mm.
Um, while we're on the topic of regulation, let me throw another idea out there, which is that, I'm a very keen student of financial regulation and was very critical of what was done in the aftermath of the financial crisis when we overloaded regulation on the financial sector and inhibited its ability to let the economy rebound. Now, the big risk, I think, is we're about to do, or we're doing the opposite. We're relaxing financial regulation and encouraging financial excesses that I worry will be a major problem in coming years.
Yeah. Yeah, points well taken. So the myth of deregulation, I can see your points there. Now the other plank that Trump has is on the fiscal side. It's confusing, I have to say, in terms of what the fiscal plan is, because on the one hand, he has talked about fiscal prudence, balancing the budget, and so on. But on the other hand, he seems to ring fenced all the big spending programs, and he wants to cut taxes. So when you do the maths, he either has to cut like Medicaid massively, or he'll have to cut defense massively, which aren't sort of very popular. And then you have the Doge, Elon Musk Doge thing, but federal workforce is relatively small in the grand scheme of things. I mean, it's been declining over the years, so there's not much sort of fat there. So, I mean, how do you square the circle here on the fiscal side?
Well, I think the best approach is to do a sort of, as I keep saying, Trump at face value and just take all the statements and fit them into
Yeah,
like a set of government accounts and say, well, this piece is gonna do this is gonna do that. And the net, when you put it all together, and you sort of summarized it quite nicely, is that there'll be fewer tax revenues and higher spending, pretty much.
okay.
You say, well, okay, the Doge is gonna come in and, halve the federal workforce. Well, first of all, they won't. And second, as you point out, even if they did that, it wouldn't have a material effect on spending. What you really need to do to cut spending is to affect the mandatory pieces of the equation. Obviously, interest payments, hard to touch those, although don't rule out Trump trying to. We can come back to that in a minute when we talk about the Fed, but don't try and rule out, Trump having to do something there. But I don't see it politically feasible for the Republicans to make big cuts in what you might call the welfare programs, because unlike the popular narrative, most of them go to people like me. I'm now on Medicare. It's
Okay.
quite good. Best healthcare system I've ever had. It's great, and it's very expensive, and it's ridiculously expensive, and it will get more and more expensive as people get older and older.
Yeah.
The average population gets older and older. So there's no way we can address our budget problems in the United States without raising taxes in some form. And that is the nut of, we had a choice in the election. We could have gone for a party that was going to raise taxes or one that's going to cut them. And the choice that the country made was to cut taxes, at least relative to the sort of ongoing
Mm,
profile that they were following. And that has public finance implications. And by the way, of course, that's something the bond market has long since woken up to since the election.
yeah. And from a growth perspective, then, do we end up with a positive fiscal impulse for this year or not?
Not really, because you know, the real event here is that the tightening that was heading our way in well, actually in 26 is not going to happen.
Okay.
There will be some modest spending restraint. You know, we talked about cutting government workers and some things like that. There'll probably be some modest tax cuts, you know, around the edges to try and, you know, he talked about cutting taxes on tips and, you know, a few other gratuitous measures. So net, I would just look for the budget, the fiscal thrust impact to be quite flat over the next couple of years. And that's a difference to what would have happened if Harris had won and the
Yeah.
Democrats had won, because there would have been net tightening in that period.
Yeah. And then we'll come back to Trump and the Fed when we talk about the Fed. But on the economy more generally, on the growth picture, you know, one of the sources of strength of the US economy has been the consumer.
Well,
Um, you know, how do you see the consumer right now? What's the state of the consumer?
yeah, I mean, to be honest, I've probably been consistently surprised since we've gone through this year about how robust consumer spending has been. Then you back out the numbers and you realize, well, income growth's been okay, but we've also had very healthy balance sheet developments, you know, wealth effects, which have helped push the saving rate, at least as currently measured, down slightly. So that's been the backbone of resilience. Looking ahead, I'd say if I was trying to, you know, keep a robust consumer, the last thing I do is to raise sales taxes, if you see what I mean. And that seems to be the first thing he wants to do. So, you know, I think one of the things that will dawn on the administration once the tariffs come in is that consumer spending will be weaker than had previously been the case. So, you know, that creates this tension, I think, as 25 evolves into 26 of, you know, how do we, you know, how sustainable is this policy that he's putting in place? You know, will he do what he did in 2019, early 2020 and kind of back away from it? Um, let's
And so,
see.
what's your growth profile for this year? Because I've noticed over the past, say, month or 6 weeks, you know, everyone's been revising up their US growth forecast. So there seems to be this sort of US exceptionalism view, fairly positive view on the US economy for this year. Where do you fit into that?
Well, I suppose I too have been revising up my near-term forecast because I expected 2.5 growth to slow to below 2 at the end of the year, but it hasn't. Um, but I still somewhat doggedly retain the view that we'll be slowing closer to 1 by the end of the year and at a weak point in the early part of 26. And that really goes to this idea that the tariff and autarky policies are negative for growth, you know, including the labor supply point we talked about earlier.
Yep, understood. And so where does that leave inflation?
Well, it leaves it with a hump ahead. Um,
Okay.
so, at least in my scenario, I mean, again, one of the things that's happened, if I go back, look at my inflation forecast, I've actually changed it a lot less than my growth forecast through the past year. But the decline that I'd been penciling in for the last part of last year just didn't happen. And in fact, if anything, we've hooked back up, you know, from sort of 2.5 to 2.75%, let's say, something like that, you know, including today's numbers. So as we look into next year, sorry, this year now, you know, I think there's this optimism that we'll get these very powerful base effects because, you know, the big increases a year ago, and we're sure not to get them this time. Well, I'd be a little careful about that one because I don't think the CPI and PCE seasonals fully account for the fact that as producers are now more in a price raising mode than a price stability mode, you see more increases at the start of the year. People raise their list prices on January the 1st. So I would expect another chunky January increase and some February carryover in the inflation numbers. So, and I wouldn't panic at that in the sense of saying, oh my God, this is definitive evidence of a reacceleration. It's just possibly some quirkiness in some of the seasonal adjustment in a world where we now have more price increases going on. That's giving us trend inflation closer to 3 than 1.5, let's say. So that's a big difference from where we were 4 or 5 years ago. But anyway, that's one point. But much more important is I'm assuming that the tariffs get implemented in the second quarter, or at least by mid-year. And that gives us a bump in inflation. And I don't want to bore everyone with my math and my arithmetic of pushing this all through, but I have the core BCE deflator rising to about 3.5% by the end of the year on a year-on-year basis. And that's really just tracing through the Trump at face value tariff increases and feeding them through into the goods market environment and the broader CPI. It would be very analogous to, when Japan raises its sales tax, it adds to the headline inflation rate. When the UK raises its VAT rate, it adds to the inflation. You can say, well, it's not inflation. It's a one-off price level adjustment. But if I'm sitting in the FOMC in July or August, September, July or September, and I'm seeing these numbers and I'm seeing wages pick back up again, I'm not sure I can sit there and do nothing. So my most extreme difference between my view and, the consensus is I actually have the Fed hiking in September. I have them not cutting at all between now and then, and I have them hiking in September. And that isn't, it's not a mad dog view. It's a Taylor rule view. I made it mad dog, but it's Taylor rule based on the evolution of the inflation development specifically. Growth will be tailing off a little bit, but the problem here is that if the labor supply is so weak, the unemployment rate won't be going up.
Okay, yeah.
But activity numbers will be going down in some fashion, and arithmetically, and that gives you, I think, the requirement by the Fed to hike rates. And at that point,
Fed on hold, then hiking September, one hike for this year then? Or
at that point, I think all hell breaks loose. And that's when Powell's, if he hasn't already been replaced, that's when Powell's replacement gets named and Trump starts saying he should take over straight away. And I think things could get quite messy at that point.
So you think there's a high risk there could be some Trump interference, in that sense?
I think, like you say, well, it won't be meaningful because he'll just stomp and shout, won't be able to do anything. And I think that will be the outcome. But it will produce some market mess, I think.
Yeah. I mean, when you say just this Fed profile, it reminds me a bit of the 1990s, where they had that big hiking in 94. Then between like 95 to say like 2000, there was these like mini hiking cycles that we had sort of back then. I mean, is there a parallel to that period, would you say? Or was that just, aside from that mini easings and hikes, that's a whole different regime to today?
Yeah, I mean, the problem with all these parallels is so many other things, so many other moving parts in that period. Obviously, US monetary policy at that point was increasingly moving from being purely US driven or US determined to being more globally determined. A lot of the easings in the late 90s, or the easing in 98 specifically, was driven by the Asian crisis and external crises. I think what's different this period versus then is, back then we were having debt cycles driven by private credit, both domestic and external. Now, I think the problem is public debt and the issues of sustainability of not just US Treasury debt, but broader public debt in the DM economies and beyond.
Yeah. You mentioned beyond, and there seems to be this pessimism towards Europe. I mean, are you do you think the picture is that bad in Europe, or do you think it's warranted?
Well, yeah, I think it depends where you sit. If you're in Spain or even Italy these days, Greece, great example. Things look pretty good, better than they've looked since the first 5 years of the euro, or so. If you're sitting in Germany, it's the exact opposite. Austria, maybe the Netherlands. So I think this is a case of intra-European rotation against the backdrop of an average poor performance, if you see what I mean. So there's no getting away from that average poor performance. And of course, it's hard to scale the shock from Russia, broadly put, not just Ukraine's invasion, but the whole, Germany made a huge bet on Russia starting in the mid to late 90s. And it effectively said the way we can become the United States is by kind of bringing in the Russian farm belt and the Russian resources belt that kind of will make us feel like the US. The US has got the Midwest and the resources, and we can mimic that by becoming brothers with Russia. And that bet was bilateral across the parties in Germany, and it just worked out really, really badly. And so I think what we're seeing is, the downside of that, the long downside of that. And on top of that, Germany in some fashion benefited from everyone else's profligacy in the euro area because it kept German industry competitive and strong demand for German industry within the region. Now everyone else has sort of got German religion on competitiveness. It puts the, let's call it the Deutschmark area at a disadvantage. Effectively, Germany needs a devaluation within Europe, and it can't have one. So I think that's the biggest problem that Europe has, at least for now. One argument would be that one of the best things Trump could do is actually help resolve the Ukraine crisis in some fashion. It may not be good for Ukraine, but it might actually be good for Europe if somehow peace breaks out in the region. That could be a big lift. Other than
And
that,
in terms of policy for Europe, I mean, what is there something the ECB can do? Obviously the market, most people expect them to do 3, maybe 4 cuts this year.
yeah.
Is there some kind of big fiscal thing after the elections in Germany?
They'll get back to neutral. So the ECB in some fashion will be, well, we've already seen Sweden and a couple of other, countries move ahead of them, but the ECB will be the most aggressive, but one of the most, and not as aggressive as Switzerland, but will be the most aggressive of the easers amongst the major DM economies. And rates will get to 2%, probably not below, but 2%. Of course, this is a region, if you're going back to sort of Taylor type discussions, where, the unemployment rate is still at a record low. So paradoxically, although we've got all this pessimism on growth, we actually have the best performing labor market that Europe's ever had. Maybe not saying much, but it's kind of impressive, and it's genuine. I think we're seeing in countries like Spain a real rebound in the employment picture.
Yeah. Okay. No, it's great. And then the UK, I mean, your former
Oh,
country
I
of
mean,
residence.
the poor old UK suffers from, it seems like it has everyone's negatives and no one's positives, if you see what I mean. So, I think the UK, in the same way that the Euro area, specifically Germany, is suffering from the sort of dislocations from Russia, I think the UK continues to suffer from the dislocations from Brexit on the growth side, without any sort of offsetting benefit from broader global integration. Although I'm a little more optimistic that maybe the Labour government will go down that route than the Conservatives were able to. The problem is that, dare I say, it reminds me of my hometown soccer team, Luton Town, where, we've got our big emphasis on long-term investment to improve the sustainability of the club. But meanwhile, we don't spend any money on players, so we're sinking in the current period. So the UK kind of has that same broader development going on, that there's an effort to try and bolster long-term investment and create conditions to do that. But in the near term, aggregate demand is soft and likely to weaken further. So the outlet, I think, for the UK, not Luton Town, but the outlet for the UK is that the Bank of England is probably going to ease a bit more than at least as until we got to today. But things have changed a bit with the inflation number. But I think the Bank of England is going to ease more than the market's been thinking.
Yeah.
That 24, 25, there were some countries that did all their easing in 24 and will step back in 25. And there are others that kind of waited and will ease more in 25. And the Bank of England's one of those, I think.
Yeah. And then we have Japan, which is the
Yep.
one that's on the other end. They're likely to hike possibly at the end of January. Is their story kind of positive still, like in, or not?
Well, I think you got to sort of, say what's my criteria for saying the story is positive?
Okay.
Is Japan going to have a strong growth phase ahead? No. Japan, and a lot of that is demographic and structural. Is Japan's surge in the equity market done? I think yes, because of the rate story, and also because the first 10 years of Abenomics were all about a massive redistribution to profits. Now that's beginning to be unwound, and the wage share, GDP, will get restored. So that's probably better for consumption, but it's not great for the Nikkei and for the equity market. What I think is happening in Japan, which is kind of, you could say, the implicit message or the implicit target of all these policies, is that the public finances have actually improved quite a lot compared to what people thought they were going to be, including myself. And the Japanese public finances are a bit kind of cloudy. The data aren't timely and they're not well presented. But their budget deficits really come down quite sharply over the last couple of years. And a lot of that has to do with the buoyancy of tax revenues, which has to do with the buoyancy of nominal GDP. So if you define success as putting public financing on a more sustainable footing, then yes, there is more success. But this idea that UADA has, that now we've restored 2% inflation, everything will be great again, and we can get back to solid growth, that's just not the way the world works, as far as I can see.
And how much will they hike by in the end, do you think? Or
Well, I think so. It really comes back to a discussion of where do you think Japanese neutral is. And I suppose what I did, again, somewhat rashly, perhaps a month or two ago, is I raised my estimate of Japanese neutral to 2%, because I said, well, look, potential is close to zero. And they seem convinced 2% is the inflation number that they're going to achieve. So QED, that's probably a reasonable neutral number. Maybe we should shade it a little bit. But I guess in my own forecasting, I've got them raising rates to 1.5% as we go into 2026, and sticking there. But you could definitely convince me that they would go higher than that. You can also convince me they'll go lower if there's a massive problem in the global trading system, or, as I alluded to earlier, some kind of global financial crisis, as some of this sort of optimism on crypto and AI begins to unlock.
Yeah. Okay, no, that makes sense. And then, of course, there's China, which was supposed to be the other part of the twin engine of global growth, but it seems to be spluttering for the last few years. I mean, the way people characterize China is it's like Japan of the 1990s, sort of encumbered with balance sheet problem, lost decade, they can't do anything about it, poor demographics, and so on. And so, the picture doesn't look very optimistic. And then you have Trump in power as well. That's probably not going to help China, which is reliant on exports. So it's really easy to paint a very gloomy picture around China. Are we too negative, or is there something?
I suppose the answer is probably no, but it's all relative, if you see what I mean. In some fashion, I think of all these East Asian countries as having gone through the same process, and including in that the demographic transition. So if you look at sort of somewhere like Korea, it's also, it's not had the extreme problems that Japan, at least so far, the extreme problems that Japan has had, but it's it's transitioned from 8% growth to 3 to 4, now down to sort of 2 or more like 1. And I think that's sort of where China is headed. I mean, I've been sitting with a 3 to 4% growth forecast for the out years for a while for China, and see no reason to change that. I've got a little bit more action in my 25 forecast than I had 6 months ago, because I think they are really doing something significant about their property problems. They're not, you can't, you can't go back and wipe them out and restart again. But what you can do is, as you mentioned, some balance sheet operations to effectively take a lot of the bad assets in the property sector off private sector balance sheets and effectively turn them into public housing. And one of the benefits that China has relative, I was going to say to Japan, but I'm not even sure that's true, is that its housing stock, because of its developing country nature in some fashion, its housing stock is still underbuilt and it doesn't have enough good quality housing. So there's still the need for people to move from poor housing to better housing, if you see what I mean. That need isn't there in developed countries, so it's harder to sometimes work these excesses off. But on the other hand, I don't see, once you clean up this property problem, I think it'll lift property prices. So one of my bets in 2025 would be that Chinese house prices will begin to turn back up again. And that's an important factor. But I don't think it's going to somehow change the Chinese growth outlook. As I say, we'll still be stuck in this sort of 3 to 4% rut with a consumer that is quite soft. And of course, globally, that's a problem because we were counting on the Chinese consumer, as you said, to kind of pick up the slack where maybe the US consumer left off.
Yeah, yeah. And so we've done this big run around the world. I mean, so how does this translate to markets in your eyes?
Well, I suppose fundamentally, I think the market's got itself correctly positioned in terms of, we're still in a rate cutting cycle. The nature of that cycle will rotate less in the United States, none in my view in the United States, and probably more in some other economies. I mentioned the UK, also Australia, will begin in earnest as we go through this year. Other countries that are already adjusted, like Canada and Sweden, will tail off. So I think the short end of curves, I see the biggest mispricing in the Fed, where there's still a bit of optimism we're going to get cuts, and I've got my hike, and probably not enough optimism in somewhere like the UK, probably Australia as well, where the rate cutting cycle will be more pronounced. Having said that, the longer end of the curve, in most countries, I think, has upward pressure. So, in countries that are cutting, the potential for bonds to rally is constrained by the fact that you've got inflation worries, secular inflation worries, I would characterize them. You've got bond issuance worries from the fiscal picture I alluded to earlier. And then I think another factor is this sort of growing recognition that term premia all got so suppressed by QE over the last decade that there's a warranted unwinding in those relationships, and in a sense the market's been slow to do that, and I think is kind of doing it more recently as a catch up to some of these changes.
Yeah. And then equities?
Pretty. I mean, I have a skewed bias, I have to admit, I always miss out on equity rallies, and
That's the economist in you.
not enough. I'm too old fashioned. Like I look at
Fundamentals.
valuations and silly things like that. But I am concerned about the relationship between bond yields and equity yields.
Yeah.
I mean, that
Yeah.
strikes me as an aggregate overhang. And then I'm even more concerned by what I view as the speculative excesses in, what let's call them the Magnificent Seven, or at least in the areas of sort of AI euphoria. And crypto to me is just an expression of pure financial uh, excess, pure
Yeah.
financial speculation and excess, and it's an accident waiting to happen, in my view.
And the dollar, presumably, from your view, it sounds like you would be positive on the US dollar.
Positive on the US dollar in the next year, much more cautious in 26.
Yeah.
But that's got a lot to do with the sort of rotating interest rate, probably also growth picture. Because I would see some economists doing better in 26 they do in 25, whereas I see the US doing worse in 26 and 25.
Okay, great. Okay, we've done a big run around markets and the economy. I did want to round off with a couple of personal,
Yeah.
well, one personal question. I always like to get some cultural input from you. Have you been reading any good books or watching any fun TV shows or films?
Yeah, I'm not much of a TV watcher, to be honest, but I'm a big reader, and I quite a few sort of things have piqued my interest. I mean, there's this one book that I just finished reading called AI Snake Oil, which is definitely worth a read because, and if I can even advertise it here,
Okay, yeah.
couple of Princeton academics who this is the best book I've read recently to put the whole AI boom into context. And it's not saying AI is snake oil. That's not the point of the book. It's to say there are some magnificent, fantastic aspects to this. And then there are some very negative aspects. And it sort of comes down to generative AI being very positive and predictive AI being worryingly negative, worryingly bad. I'll leave it at that point. I'm also very much into biographies, and I've been fascinated by. I like my graduate school at Oxford was Nuffield College, and I've become very obsessed with Lord Nuffield, who is better known perhaps to most people as William Morris, who was the founder of Morris Motors. And if you're looking at Britain and what went wrong with Britain, it's sort of, okay, why don't we have the William Morrises anymore, who were these kind of tinkerers? He started off mending bikes on Oxford High Street, and within 15 or 20 years, he'd built one of the biggest car companies in the world, pretty much single-handedly. No education, no meaningful education. And, went on to become a tremendous benefactor and donor of funding to medical institutions in particular. But it's a kind of, I'm fascinated by like what went, why don't we have these people anymore in Britain? You know what I mean? We sort of we have them in the US. And in fact, what's happening in some fashion is in the US, we're attracting them from abroad. So the US, when people talk about US exceptionalism, I don't think it's necessarily the US population that's producing that exceptionalism. It's the atmosphere of the US that's creating that exceptionalism. And some of it's a capital market story, as Draghi has been pointing out with his report. But I think a lot of it is a sort of entrepreneurial atmosphere that is very different. So someone like Elon Musk, and by the way, I've got Elon Musk's biography by Walter Isaacson also on my must-read list, because if you want to understand this guy, his early years are very, to say the least, they were very formative.
Okay.
So I'll leave my recommendations at that point.
Okay, great. No, that's fantastic. And then finally, what's the best way for listeners and viewers to get in touch with you or get access to your research or subscribe?
Sure. Well, we're easily found at suttleeconomics.com, SUTTLE economics, all one word.com. And if you want to reach out to me personally, I'm at my Phil at suttleeconomics.com. So PHIL at suttleeconomics.com. Or if you can't find me either way, go through Bilal because he's such a nice guy.
Very kind, Phil. Yeah, and I'll make sure to connect them to you. No, fantastic, Phil. As usual, very comprehensive, very thoughtful, very thorough, and I really do enjoy your daily that you write. I think it's by far the best daily on the economy out there. So I do urge everyone who is interested in macro and markets to get in touch with Phil.
Gotcha. And good luck with everything. You're doing a great job, and keep that job going.
Great. Thanks a lot, Phil.
Thanks, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.